When we picture financial security, uh, most of us still default to this very Hollywood image.
Yeah, oh yeah. The giant steel bank vault.
Exactly. You picture the 2-foot thick doors, a complex locking mechanism,
Lasers crisscrossing the room.
right? Armed guards at the perimeter.
Hmm.
It's physical, it's impenetrable, and, most importantly, it's very easy to understand.
It gives us this tangible sense of comfort, you know? We like the idea that the bad guys are on the outside, the money is on the inside, and there's a very clear, heavily guarded wall in between.
But then you look at how money actually moves today. We are talking about trillions of dollars flying around digitally every single day.
Trillions, yeah.
And when you look closely at that system, you realize the steel vault is, it's just a comforting illusion. We are operating in a digital landscape where the bad guys don't need a drill or explosives.
Not at all.
They just need an email address, maybe a manufactured sense of urgency, and honestly, maybe an AI voice clone of your company's CEO.
Which completely shatters that traditional perimeter defense. Because when the threat mathematically appears to be coming from inside the house, the old ways of guarding the vault are rendered entirely obsolete.
Right.
The mechanisms of theft have just fundamentally changed.
And that shift is exactly what we are getting into today. We are taking a deep dive into the massive overhaul coming to the automated clearinghouse network.
Most people just know it as ACH.
Yeah, ACH, the literal backbone of money movement in the United States. It's the system processing your paycheck, your mortgage payment, and massive corporate invoices.
It touches basically everything.
It really does.
We have the technical ground-level compliance breakdown on one hand, and then the high-level industry strategy on the other.
Totally. So the mission for this deep dive is to break down exactly how this financial backbone is upgrading to fight advanced modern fraud. We'll cover why the liability for that fraud is shifting and what this means for you.
Yeah, whether you are involved in business operations, managing payroll, or honestly, just someone who expects their direct deposit to clear on Friday.
Exactly.
Oh.
Okay, let's unpack this, because on the surface, you hear financial compliance rules, and it sounds like something that might cure insomnia.
It sounds incredibly dry.
Right. But we are actually looking at a massive high-stakes cat-mouse game between global financial institutions and highly sophisticated cybercriminals.
It really is a battle, and to understand the mechanics of these new Nacha 2026 rules, we really have to look at the philosophical shift happening across the industry.
Right, because things are changing in a big way.
Huge way. For a very long time, the ACH network operated on a somewhat reactive model. This was especially true when it came to what the industry calls credit push fraud.
Let's stop there for a second, because the sources mention credit push fraud quite a bit. In plain English, how is that different from, say, someone just stealing my credit card number and buying something online?
The mechanism is entirely different, and honestly, that's what makes it so dangerous. With credit card fraud, someone is pulling money out of your account without your permission.
They're stealing it directly.
Right. But a credit push is when you, the account holder, are fully authorized to send the money, and you willingly push it out of your account.
Wait, so I'm the one sending it?
Exactly. The problem is you've been tricked into pushing it to the wrong person.
Wow. So the system sees a totally legitimate user logging in, using their real passwords, and intentionally hitting send.
Yes. Think of business email compromise, or BEC. A fraudster compromises a vendor's email system. They send you an invoice that looks completely legitimate, but they say, hey, we updated our banking details. Please send the payment to this new routing number.
Oh, man. And then what?
Your accounts payable clerk updates the system and pushes the payment right to the fraudster's account. Or consider authorized push payment fraud, often called APP fraud.
Let's break that down, too. What exactly is authorized push payment fraud?
APP fraud is essentially a highly targeted scam. It might be someone calling a consumer, pretending to be from their bank's fraud department.
Oh, I've heard of this.
Yeah, they convince the person that their account is compromised. The scammer tells them they need to urgently transfer all their funds to a safe account, which, of course, the scammer controls.
And again, the user's authorized, and they are doing the pushing.
Exactly. Historically, the industry would just wait for the victim to realize what happened, flag it, and then everyone would scramble to try and claw the money back.
And once that money lands in the fraudster's account, it usually gets moved offshore or converted to crypto almost instantly.
Oh, within minutes.
So the shift here is moving away from just watching the tragedy happen. It's like moving from just having a security camera that passively records a break-in after the fact.
Which is useless once the stuff is gone.
Right. Moving from that to installing an active alarm system that automatically verifies everyone's identity and physically locks the doors before the burglar can even step foot on the property.
That is a perfect analogy. What's fascinating here is how Mark Dixon from Nacha Consulting frames this evolution. He points out that this isn't about inventing entirely new, burdensome processes just to punish companies.
Right. It's not just red tape for the sake of it.
Exactly. These 2026 amendments are designed to force the entire industry to work collaboratively on identification. It's codifying risk management practices that, frankly, should already be happening.
So the days of passive observation are over.
Completely over. Now, all participants, the originators sending the money, their originating banks, and the receiving banks, they all have to actively monitor transactions and be able to prove they're doing it.
Because the targets are the heavy hitters now. We're talking vendor impersonation, payroll diversion, where they reroute employee paychecks, account takeovers.
And even AI-enabled social engineering and deepfakes.
Right. The network is essentially saying the minimum standard for entry has to evolve because the threats have evolved.
And importantly, the liability is shifting heavily toward the originators. If your company is the one initiating the payment, you are now largely responsible for verifying that the account on the other end actually belongs to the person or company you think you're paying.
Which is a huge deal.
Yeah.
But if these new automated alarm systems are so critical to stopping fraud, why are we talking about 2026? I mean, why not just flip the switch today and mandate this tomorrow?
Because of the sheer scale of the ACH network,
Yeah.
you cannot overhaul the plumbing of the U.S. financial system overnight without causing massive disruptions.
That makes sense.
So the rules are being implemented in two careful phases. Phase 1 hits on March 20, 2026. This is targeted at the biggest players in the ecosystem.
Who are the biggest players?
We're talking about originating depository financial institutions, large originators, and third-party senders who processed over 6 million ACH transactions in the year 2023.
Over 6 million transactions in a single year. That is a staggering volume.
It really is.
That's thousands of payments being processed every single day.
It is massive. But Phase 2 is where it gets very real for everyone else. Phase 2 officially hits June 19th, 2026.
Okay, so just a few months later.
Though Mark Dixon notes in the podcast that because of a Juneteenth holiday weekend, the effective date for the industry to actually execute this is June 22.
Got it. And who does Phase 2 cover?
This phase extends the requirements to all remaining ACH originators, regardless of their transaction volume. If you process 5 million payments, or just 50 payments, you are bound by these rules by June 2026.
Okay, let me ask a practical question here on behalf of a mid-sized business owner listening to this. Let's say I run a manufacturing company with a relatively small accounts payable team.
Okay, pretty common scenario.
Why can't I just have my two best accounting people, say Jim and Pam, double-check every invoice? You know, the classic four eyes principle where two humans have to sign off.
Right.
Why do I need to overhaul my tech stack if I trust my people? Isn't human intuition our best defense against weird payment requests?
It's a very logical question. Historically, that four eyes approach, two humans verifying a transaction, was considered the absolute gold standard of internal controls.
It's what everyone was taught to do.
Exactly. But the Kiraba FAQ details why manual processes simply fail against modern high-volume threats. Human error is too significant a variable when you are dealing with AI-generated invoices that mathematically match your formatting.
Oh, wow.
Or, deepfake audio of a CEO demanding an urgent wire transfer over the phone.
So Jim and Pam are great,
Yeah.
but they get tired, they get distracted, and they probably can't detect microscopic anomalies in a PDF invoice at 4:20 on a Friday.
Exactly the problem. If we connect this to the bigger picture, the new standard required by Nacha is what they call commercially reasonable fraud monitoring.
Commercially reasonable. What does that actually mean now?
Well, in 2026, commercially reasonable no longer means a checklist on a clipboard. It means automated, risk-based controls. We were talking about real-time prepayment scoring, AI pattern recognition, and automated velocity checks.
Okay, let's break down automated velocity checks. How does that mechanism actually work to stop fraud?
Velocity checks track the speed and frequency of money moving to a specific account. Let's say your company pays a specific paper supplier once a month for $10,000.
Okay, pretty standard.
The automated system learns that baseline. Suddenly, someone submits 5 different invoices for that same supplier in a single afternoon, each for $9,000.
Oh, I see.
The system flags the velocity, the unnatural speed and frequency of those payments. A human might just process the paperwork if the invoices look correct, but the system sees the broader mathematical pattern and stops it.
So you need these systems running in the background, and you need the receipts to prove it.
Hmm.
You have to maintain searchable audit trails and documented verification records for every transaction.
You absolutely you.
If an auditor comes knocking, you can't just say, oh, we looked at it. You have to prove, with data logs, that your system verified the payee's identity before releasing the funds.
And a lot of business leaders hear that and worry it will slow everything down. They picture gridlock.
Yeah, it sounds like a massive bottleneck.
But proper technology implementation actually accelerates payment operations through something called straight-through processing.
Wait, how does adding a layer of AI security actually speed things up?
Because when you have a sophisticated system handling the anomaly detection, it can instantly clear the 95% of payments that perfectly match historical data. That's straight-through processing.
Ah, okay.
The low-risk verified payments just sail straight through without needing human intervention. You are only tapping the brakes and requiring a human review for the 5% of exceptions that get flagged.
That makes a lot of sense. But how do these automated systems actually know what is low risk or high risk?
Yeah.
I mean, an algorithm is only as good as the data it's fed. The system needs to know what it is looking at.
Which brings us to the new web of standardized data rules being introduced.
Let's talk about those.
Starting alongside Phase 1 on March 20th, 2026, there is a new mandatory requirement for standardized company entry descriptions.
What does that entail?
Specifically, originators must use the word payroll for ACH credit entries related to payroll and purchase for ACH debit entries related to purchases.
Wait, mandating a specific word like payroll? That sounds incredibly simple compared to all this AI pattern recognition we just talked about.
It sounds basic, right? But Mark Dixon describes this as a crucial piece of the puzzle. When you force this standardization across millions of transactions, you give the originating banks and the receiving banks the exact data they need to spot mismatches instantly.
Right, he used a great example in the podcast to illustrate this. He talked about a CCD transaction, which stands for corporate credit or debit, basically a standard B2B payment.
Right.
Imagine a B2B corporate transaction is being sent to a regular consumer's retail checking account. Now, that alone might be a little odd, maybe an independent contractor, so you wouldn't necessarily block it.
Exactly, it happens.
But if that corporate transaction is also tagged with the new mandatory payroll description, suddenly the puzzle pieces don't fit at all.
Because why would a B2B corporate invoice payment be going to a personal checking account and labeled as payroll? The structural logic of the transaction just collapses.
Wow.
By enforcing that simple standard tag, the system creates an immediate, automated red flag. The bank can pause the transfer and investigate before the funds disappear.
And this heightened scrutiny is being applied to very specific high-risk events, too. The new rules demand extra verification for things like off-cycle payroll runs, first-time payments to a new vendor, or sudden changes to bank details for an existing vendor.
Yeah, anything out of the ordinary.
Here's where it gets really interesting to me, looking at the psychology behind these rules. Dixon mentions that all of this data transparency and anomaly detection does something profound to the human element of payments.
It really changes the dynamic.
Fraudsters thrive on manufacturing urgency. They create a crisis. They send an email saying, pay this invoice right now, or the supply chain halts. Or update my direct deposit today, or I miss rent.
Yes, they want the employee panicking.
Because panic overrides logic. If you feel like your job is on the line, you don't take the time to call the vendor and verify the routing number.
But these new rules, by forcing automated holds and reviews on anomalous transactions, essentially kill that manufactured urgency.
They just take the decision right out of the panicked employee's hands.
Exactly. The system stops the payment and basically forces the human operator to take a breath and ask, does this actually make sense?
So the automation handles the sheer volume of everyday transactions so that your human team has the mental bandwidth to critically examine the exceptions.
Precisely.
They aren't rushing to manually process 10,000 invoices. They're taking their time to investigate the 50 that the AI flagged as suspicious.
It's a very elegant way to blend automation with human judgment.
It is, but this brings up a major contradiction in the source material that we definitely need to explore. We just spent all this time talking about slowing down, verifying, running anomaly checks,
Right.
basically installing speed bumps on the ACH network to check for fraud. But simultaneously, Nacha is pushing to move larger amounts of money faster than ever before.
Ah, you're referring to the same-day ACH limits.
I am. The transaction limit for same-day ACH is increasing to $10 million.
10 million.
Historically, moving $10 million in a single day through ACH would have been unthinkable because of the risk involved.
This raises an important question. How do we balance massive $10 million same-day transfers with these heightened fraud risks?
Right.
The banking industry used to have a very common refrain. Faster payments means faster fraud. If you have less time to catch a mistake, the fraudster gets away with the money faster.
So then why the massive increase? I mean, why take that risk?
The answer to this contradiction lies in the growing confidence in the very rules we just discussed. The reason Nacha feels comfortable raising that limit to $10 million is precisely because of the data transparency and collaborative monitoring rules rolling out in 2026.
So the $10 million limit isn't just a reckless gamble to stay competitive with other payment rails.
Not at all.
It is a calculated move that is only made possible because these new 2026 safety nets, the AI scoring, the standardized entry descriptions, the audit-ready verification, all of that is being installed underneath it.
Exactly. Mark Dixon refers to this as the natural evolution toward modern ACH. Large corporations need to move massive liquidity quickly for wholesale B2B transactions.
Sure.
To maintain parity with other fast payment rails, ACH had to increase its limits.
It makes me think of a city's plumbing system. You can't just crank up the water pressure to 10 times the normal rate if you still have rusty pipes from the 1970s.
Right, they'll just burst under the strain.
Exactly. These 2026 rules are replacing the old pipes and reinforcing the joints so the system can handle the massive pressure of $10 million daily transfers without leaking money to fraudsters.
That is a perfect way to visualize it. You have to fix the infrastructure before you increase the pressure. And if we look at how that domestic plumbing connects to the international water supply, the timing of these domestic rules is definitely not a coincidence.
Yeah, let's zoom out to that global view for a second. This deep dive wouldn't be complete without looking at how these rules fit into the international financial ecosystem.
Definitely.
The sources note that international ACH transactions, or IETs, are also becoming much more data-rich to align with global ISO 2022 formatting.
It's a mouthful.
Yeah, ISO 2022. For those of us who aren't payment engineers, what is that and how does ACH adapt to it?
ISO 2022 is the new global standard language for financial messaging. It allows banks all over the world to send incredibly rich, structured data along with a payment. The challenge is that the U.S. ACH network wasn't originally built to speak this new global language. But Nacha is adapting by using what are called addenda records.
Addenda records. What is the mechanism of an addenda record? How does it actually translate the data?
Think of an addenda record like a digital sticky note attached to a payment file. Even though the core ACH transaction wasn't built for the new global ISO standards, these digital sticky notes allow banks to attach the exact structured data the international system is looking for.
Oh, that's clever.
It is. It means that international ACH payments will carry the same kind of deep, standardized payment story that we are seeing globally. It gives financial institutions the transparency they need to steer clear of cross-border fraud.
And when you look at where the industry is heading, like the buzz from Nacha's Smarter, Faster Payments conference mentioned in the bottom line transcript, the future sounds incredibly sci-fi.
It really does.
The two biggest topics of conversation were stablecoins and agentic AI.
Let's define those briefly because they directly relate to our compliance discussion.
Good idea.
Stablecoins are digital tokens pegged to a fiat currency, like the US dollar. They can move instantly across borders without being constrained by traditional banking hours.
Right. And agentic AI refers to autonomous artificial intelligence systems capable of executing complex, multi-step workflows without human intervention.
The example Dixon gave regarding agentic AI was wild. Imagine a treasury professional saying to an AI agent, I need you to consolidate my global cash flows into my master account, figure out the best path forward, secure perfect exchange rates, and maximize my returns.
And the AI just does it.
It just does it. It navigates multiple currencies, crosses borders, and executes the trades and transfers completely autonomously.
It's the bleeding edge of treasury technology. So what does this all mean for you, the listener? If you were sitting there wondering why you need to care about a March 2026 Nacha rule change, this is why.
Yes.
The 2026 rules are laying the foundation for the future of corporate finance. You can't participate in the incredible efficiencies of agentic AI if your internal systems are still relying on a couple of employees to manually double-check PDFs.
You just can't. And this is exactly why the Kyriba FAQ explicitly warns originators that they must audit their third-party service providers, or TPSPs, right now.
Let's expand on that real quick. Why am I, as a business owner, responsible for the technology of the company I outsource my payroll to?
Because under the new rules, the liability rests with the originator of the funds. If you hire a third-party service provider to process your payroll and their systems get tricked by a deep fake into rerouting your employees' paychecks to a fraudulent account, you are on the hook.
Wow. Even if it's their system that failed.
Yes, you have to verify that your providers have these real-time automated verification tools in place. Falling behind on 2026 compliance doesn't just mean risking fines or fraud losses. It means being structurally locked out of modern business operations.
So commercially reasonable fraud prevention is an absolute technological mandate now. It is a fully integrated API-driven defense system.
And the timeline is unforgiving. Assessing gaps, allocating budget, evaluating technology options, and implementing automated verification takes time.
It takes a lot of time.
The March and June 2026 deadlines are going to arrive much faster than many organizations realize.
So to recap our journey today, 2026 is a watershed moment for the ACH network. We are officially shedding the passive, reactive history of credit push fraud.
Absolutely.
Whether your organization processes 6 million transactions a year or just a few dozen, the liability is shifting. You will be held accountable for actively defending against fraud with documented, automated verification.
And the standardized data puzzle pieces, like those mandatory payroll descriptions we talked about, will empower banks to spot anomalies instantly.
Exactly. And all of this is the necessary plumbing replacement that allows us to safely push $10 million limits and embrace the autonomous AI treasury of the future.
It is a complete paradigm shift in how we establish trust in digital transactions.
Which brings us back to that Hollywood bank vault we talked about at the very beginning. We don't have thick steel doors anymore. We are currently building these incredible, invisible, automated systems to verify identity purely because we can no longer trust our own human eyes and ears against deepfakes and social engineering.
It's true. The human element is increasingly becoming the vulnerability, not the defense.
And it leaves me with a lingering thought for you to mull over as you go about your day. As we deploy agentic AI to take over our treasury operations to maximize efficiency, and the bad actors deploy rogue AI to generate hyper-personalized, high-volume fraud attacks.
Which they will.
Will the future of financial security simply become a silent, invisible war between opposing algorithms? A battle happening at light speed, completely beyond human comprehension, where our only job is to trust that we built the better alarm system.
It's a fascinating and honestly slightly terrifying frontier.
Check your systems, audit your third-party providers, and get ready for 2026. Thanks for joining us on this deep dive.